now we've been talking about the use of equities for funding your lifetime investing plan. But what about bonds? It seems that so many people own bonds in their investment and mostly retirement portfolios, so let's explore why. I'm going to make a statement that may sound counterintuitive and definitely will be countercultural. And that is, if our goal is to build the purchasing power of our investments over time, which always should be our goal, then the ownership of bonds or bond funds is totally irrational. As we've seen through these videos, the long-term real return after inflation of bonds has been less than half of that of stocks over the last 100 years. So an investment in bonds over the long term involves a staggering sacrifice of permanent return. So why on earth would anyone do it? Clearly, the answer is because they want to be spared the short-term volatility of equities. That is, their distressing but wonderfully temporary declines. Bonds represent a conscious decision to forego more than half of the permanent return of equities in exchange for relief from their temporary declines. And that's not too rational for an investor with a reasonable time horizon. So you may wonder, yeah, but what about income? Don't bonds pay a higher amount of income than I'm going to need in my retirement? Yes, it's obvious that the current interest rate paid by bonds is at any given moment typically higher than the dividends paid on equities. Bonds usually have a higher current yield than stocks do. While this is true on the surface, it's also a totally irrelevant way of comparing the two different asset classes. The current yield on bonds may be higher, but let's remember that the bondholder is giving up not only the price appreciation of equities, but even more to the point, the remarkable dividend growth of equities. The dividend of the S&P 500 stock index has grown at a rate of just about 5.5% since 1935, or just about twice the inflation rate. Bond yields don't grow, they just sit there. So please let that point sink in because it's really important. In fact, your long-term security in retirement may depend upon it. The only rational test of an asset's long-term income potential is its long-term total return, not its current yield.